Hey, everybody, welcome back to another episode of the 6-5 podcast. Today, driving the show, Daniel Newman here, principal analyst, founding partner, Futurum Research, joined by my esteemed co-host, 6-5 podcast partner, Mr. Patrick Moorhead. Pat, it's Friday, buddy.
I know it's Friday, and we're broadcasting from our bunkers here. It's 22 degrees, and it's Austin, Texas, and we just don't know how to handle things like this compared to, let's say, Cleveland, Ohio, or Chicago, Illinois. So, yeah, everybody's off the street. Pretty much everything's shut down. But I don't know. Here we are. It's kind of nice. I think I saw one person walking to work downtown. But no, Daniel, it is awesome to be here. It's my favorite thing to do during the week. We just let it rip, right? Let things lie where we're going to lie, and here we are.
Friday morning is all about letting it rip. And I tell you what is funny, in the green room before we went on the air, everybody, right? I was saying to Pat, I go, hey, Pat, because I've only been here 6 months. I said, Pat, when can I drive again? And you go, hey, you grew up in Chicago, buddy. Like now, and my response to Pat was, yeah, but in Chicago, they plow the roads and salt them. Here, they just leave them like ice rinks and just say good luck. Pretty much they say, stay home, right? That's the thing. So down here in Central Texas, it's kind of like you get about 10, 15 days of winter a year. And when you get that winter, it is basically like they're all snow days. It's all snow days. So my kids haven't been to school in like a week and everything's canceled. And again, I look outside and I'm like, what is going on? But that's just the world we live in. I mean, it's basically like getting snow at the equator, it seems. Anyhow, a really crazy busy week. It's been a ripsaw, seesaw, crazy week in markets. We are in kind of wave 2, as we like to call it, for the earnings palooza. And this is the last week that we're going to be kind of on all earnings before we get back to just the occasional spotted in earnings of some of our clients. But this week, there's a ton going on. We've got AMD, Honeywell, Qualcomm, T-Mobile, Google Cloud, AWS. And that wasn't it. I mean, we had an absolute bomb from Meta that almost set the markets on fire, set them ablaze. And that came a day after Alphabet came out with some great numbers that everything looked like it was going to be rosy. And then the day after, Amazon comes back and has a good number. And we are just all over. I say we're on a razor's edge around here. And we'll talk more about that in a few minutes. So we're going to talk about several different earnings today and kind of some conditions and growth and strategy. But before I do that, just a quick reminder, the 6-5 podcast, 6 topics, more than 5 minutes each. The goal was 5. We would never actually do that. We try to focus more on the analysis, getting between the lines, not telling you what is easily available and readable online. If you can find it online, we will try to get between those lines. Just as a reminder, the show is for information and entertainment purposes only. And while we will be talking about publicly traded companies, please do not take anything that we say as investment advice. Pat, I know we're going to go long because we always do, although we've got some that'll be quicker and some that'll take a little more time. But the first one I think is going to take a little more time because there's a lot to unpack. What a quarter for Lisa Su and AMD.
Yeah, Lisa Su and the team keep getting us in the habit of beating, even though, they're looking at, sometimes 40% growth. They just seem to keep beating. And they absolutely had a beat. They beat on EPS by 21%, beat on revenue by close to 7%. I think they were up 12%. The market rewarded their bullishness, but they had record revenue, net income, and EPS. And I think there was a lot of focus on this gross margin line. And let me pull this up. So this is AMD gross margin since 2006, and you'll see it's been a few years since they got to 50%. Now, part of this, even in 2018, was the fact that on a gross margin basis, the console businesses were lighter on gross margin, but heavy on net because they get paid NRE. So it's going to be low gross margin, but very high operating margin or net margin. So the market absolutely loved what they saw here. And from a pricing standpoint, Ryzen and GPU ASPs were up I'm not surprised because with the limited availability, the company is moving wafers to higher margin products. They didn't say that EPIC had increased ASPs, but when you're selling processors for $2,000 a piece, I know that's different. What they did say about EPIC was that it was the 7th straight record quarter for revenue, and this would make sense. The company is very strong in the cloud, but they did mention some increasing strength in the enterprise, and this would make sense because it takes about, I would say, 2 years of soak time for any new processor to really become accepted in the enterprise. It was the same for Opteron when it first came out back in 2006. Now, back then it was a 2-socket and 4-socket world, and you would have been a fool not to buy Opteron. So there's a little bit of a quicker uptake in enterprise, but given the competitive state of EPIC, I'm not surprised at that delay. Had a strong guide too. In fact, without Xilinx numbers, a 45% revenue increase for Q1, nearly 51% gross margin. That is just insane. I'd have to go before 2006 if NVIDIA ever hit that. And quite frankly, they had a killer 2022 guide. 51% gross margin without Xilinx, increase of revenue of 31%, 31% versus the 45% we've seen. I see that as a sandbag, aka conservatism.
Yeah, the overall results from AMD were once again impressive. I think the number in focus, Pat, for me was the gross margin number and the expansion. There was a whole lot of speculation, especially after Intel's results, that there was Intel's results, which they obviously had some additional expense related to their process overhaul to 10 nanometer. But there was also TSM that had come out and basically said, there's going to be some price increases, and when those are going to hit, it's not exactly like, hey, we're going to raise prices and right away we're going to see those reflected into the numbers. So there was some wonder about how all these fabless companies would do. Would these higher prices potentially impact the margins? And the answer is no. The answer is that AMD is continuing to hit volume, hit growth numbers. They're expanding market share. I think we will see that in the next market data that comes out from Mercury, that they did gain some market share. The area that's been really fire for the company has been in the EPIC, but really across the whole portfolio. There's not really a part of it that you're like, God, that's really going badly for them. They are showing strength and growth everywhere. They're seeing significant revenue growth. They're delivering much higher profit, and of course, in a inflationary environment where earnings are being compressed, to some extent, the higher earnings are going to be necessary if they want to keep that share price nice and tidy and high. I think over 120, which is where it is. It had fallen for a while when the whole market had fallen. I think their earnings absolutely invigorated their base of investors, pushed the price north, and show that they know what they're doing. They know how to run their business. And Pat, what you're showing right now is their guidance, and their guidance is, they gave the full year. They're expecting significant growth. They're expecting to be able to control and maintain their high margins, their growing margins. So everything's in the right place for the company, Pat. There really isn't much in this particular report to be concerned about. The one thing I will say is a macro topic is every semiconductor company seems to be more bullish than the overall market is. And semiconductors, as you and I love to say, eat the world. At the foundation of every software, every application, every gaming console, every TV, every automobile that gets purchased are a whole bunch of chips. So if chip companies are feeling good about about their future, then the broader tech slate should also reflect positively, because at the foundation of all that technology are semiconductors. So good quarter, Lisa, Sue, AMD, congratulations. Let's keep going. Oh yeah, that's me. I'm the host. Hey, take a break, man. Take a little nap.
Man, I didn't want to get my hands slapped,
thank
dude.
you.
Sometimes I'll come in and be like, hey, who's running the show here?
Know your role, man. Know your role. No,
All
it's
right.
like I had to take a little pause there. I was giving it a good think. So let's pivot to something that's a little bit, I would say a company that you and I talk a lot about that I feel like we're constantly sort of introducing to the tech community, a company we've worked with on a number of different fronts that also reported this week, and that's Honeywell. I don't want to really spend a ton of the time on this show talking about the materials business or the safety business or the mask business, because that's not why two tech analysts get on and talk about Honeywell. I think what I really want to just take a few minutes to talk about is sort of the way the company is perceived in the market. So Honeywell is a value company. I did a market watch piece where I looked at some of the different companies that are both tech and value, and I noted that about Honeywell. And Honeywell came up a little short on their revenues and their guidance, and that caused for Honeywell a very significant sell. I think it fell like 6 or 7%. And Honeywell falling 6 or 7% is kind of like Meta falling 30%. Companies like Honeywell don't move that much, and they're seen as value plays and they're dividend plays. But what I've really been watching for with this company has been how it's been approaching and being appreciated for what it's trying to do in technology. And I'll sort of break that into three different pieces. The first piece has been recently spun off, which was the quantum business, which was a very interesting path the company went down. And now they are the biggest investor in a company called Quantinuum, which is a private company that I believe at some point will come back public. But at this moment in time, they're acting as the investor, but they're using their experience in the controls business to actually participate in a growing opportunity, which is quantum. But we're going to sideline that one for a little while until we figure out what the plan is. Are they going to de-SPAC? Are they going to IPO? But that's what's going on with Quantinuum. And Quantinuum is a really interesting company because they've definitely been on the leading edge of a number of different quantum breakthroughs, of offering the first available as a service quantum software in security. So they're doing some interesting things. But like I said, right now, since we're talking Honeywell's specific role here is playing investor at this moment in time. And the second and third tech overlaps that I really believe need to be given attention is Honeywell as an edge IoT and software provider. So when you think about where all the data that comes into our systems of record, you got ERPs, you got CRMs, you got smart cities, smart grids, automotive, jet engines, and planes. All that data, companies like Honeywell have a really unique position. So they have what's called their Forge software. And Forge has really been working closely with companies like SAP and like Microsoft and your traditional IT systems of record to basically grow and create more validity in the market as a software and data company. Now it's still early, but it is, passing $1 billion in revenue, this part of the business for Honeywell. And over the last couple of quarters, I've had multiple opportunities to sit down with their leadership, including a recent pod that I did on making markets, the less cool podcast I do because Pat isn't with me on it. But I talked to Darius Adamczyk, the CEO, and I talked a lot about that. The pivot to software is going to be a huge one for the company because if they ever want to be appreciated like a tech company and get the valuations of a tech company, they're going to need to be seen as one. And I will say to date, it's still pretty nascent to most of the market, but it is an opportunity. Forge, the edge business, IoT, smart buildings, technologies that help keep buildings safer. Those are the kind of things that they're going to be leading the way on. And the last thing, Pat, and I think you and I have both written a ton about this, worth talking about, is ESG. There are going to be two kinds of ESG companies. There's going to be companies that provide the analysis and data visualization, and those are going to be a lot of the traditional ERP companies that we know. We're going to see solutions from Salesforce, ServiceNow, SAP, Oracle, Microsoft. They're all going to have technologies that are going to help companies measure their ESG efforts, their sustainability efforts. Honeywell is uniquely positioned because of where they play in the materials space to actually enable companies' ESG initiatives. So they're going to be playing a little bit higher up the stack in terms of helping the market and helping technology companies that have made these bold market-facing statements about their ESG strategies to help them actually achieve this through sourcing, through materials planning for their products and solutions. And that's going to be an interesting money-making opportunity for the company. It's something that they're going to focus on more and more. So, the numbers themselves, this quarter was not great. The guide was not great. But the question and what I'm really looking for in the company is, can they make this pivot? And can people start to finally recognize what they're doing with Forge, with software, with ESG and sustainability in a meaningful way? I would say that answer is not clear yet. That's going to be up to leadership to really tackle that. But I do think it's a big opportunity.
Bro, you stole every piece of thing I was going to talk about. But let me do a quick.
I was trying to think of things.
No. It's fine. So a couple things I really appreciated was, if you look at the lower right-hand corner, there was a breakout of some of the financials here. And what you see here is a net P&L investment of $60 million in 2021. That's code for 2021 loss, and 150 million loss in 2022. And that's, by the way, that's called in investment. And also we saw a sales figure of $20 million for 2022. And it looks like a margin improvement of 30 BPS means that they're at least making money at the gross margin level. And I really appreciated that. To your point, about sustainable, check this out. Here's the deck. Here's slide 1 and slide 2. And listen, many of you might be bored with some of the ESG stuff, because quite frankly, every company tries to convince Daniel and I that they're an ESG company. Okay, here's the difference. Honeywell is different because they are literally at the epicenter, and I would even put SAP in here as well. They're at the epicenter of where the ESG action is. Okay, and this may I'm just going to say it. The people who create the pollutants or the energy, right? Cars just don't show up. Okay, they need to be manufactured, and at the center of buildings, at the center of factories, at the center of airplanes is Honeywell. And not only with the sensor systems, but also with the energy storage systems, with the material science and plastics that go into it. So a lot of companies are talking about ESG, but Honeywell is one of these companies that's literally in the center of it with the companies that need to make those changes. And on top of that, which Daniel talked about, is their Forge platform that then puts a data analytics capability on top of the data that are captured with their sensors, that they have a pretty robust ecosystem for, including SAP. So there we go, Daniel. I was able to squeeze something out of that. But
that was pretty good, actually. You went a layer deeper, kind of gave people the what in terms of what are those things, those sustainable data points that the company has, the fuels, the buildings, the materials, all those different things. I think visibility to that is super important. And I like that you mentioned that the hybrid infrastructure. So not a beat back or a circle back there, but you actually you underestimated yourself a little bit there. I think you had more in your pocket than you wanted to admit. So
I tried, buddy. I was sweating it. You were going through that. I'm like, oh man, I was going to talk about that.
But off the record, I went through these numbers, right? And this is the off the record, on the record, because we're live, so people can hear us. But I said to you, Pat, I'm like, Honeywell's quarter didn't give us a lot from a tech angle, and then somehow we managed to spend like 8 minutes talking about it. So that's why the 6.5 is nothing more than a theoretical at this point. So hey, let's move on to the next topic, which is a biggie that I think we will easily spend 10 minutes on, because you will spend at least 6 just to get through it all. But wow, what a great second quarter for CEO Cristiano Amon. Another one of those ones that kind of was quiet because it was reported on the day that Meta, the Meta bomb went off. But if you wanted something to feel good about that day, Qualcomm.
Yeah, absolutely. So NVIDIA crushed their fiscal Q1 22. They had a beat on the top, they had a beat on the bottom, and they had a raise. So really the trifecta of what you would want. They had another record revenue, another record EPS, and another record EBT quarter. And what I really liked is in their deck, they said we have revenues, that's QCT, revenues exceeding any other fabless company out there. And it's like, do you hear that, NVIDIA? Do you hear that, AMD? Do you hear that, folks out there? I do like that fire. And if Cristiano weren't CEO, we definitely wouldn't have hit that. Handsets, just a banner quarter, 42% improvement. And then rounded out with their growth areas, RF front end at 7%, automotive at 21%, and IoT at 41%. You know, some people are asking, hey, what's up with this 7% versus 42% on the handset? And it's very simple that RF customers buy earlier than they do on the digital side because they're quite frankly concerned with availability. And potentially the previous quarter was bigger than it should have been, but this quarter for sure was endemic of a buy ahead. So great stuff there. Their guide was really good too. $10 to $11 billion in the top line, $2.80 to $3 on EPS. Net, their growth and diversity strategy is working. Daniel, I gave you a lot of oxygen, buddy.
Yeah, well, you hit a lot of the key points. I had a chance to dig in deeper. You and I actually got a briefing from both their CFO and from Cristiano on the day of earnings. So it was great to get a chance to speak to the senior team, get their takes, ask some questions, try to get beneath the hood and say, hey, what's ahead? You mentioned guide. Just terrific. One of the things that Cristiano said that really stuck with me was, you know, the company is at this point in time by revenue the largest fabless semiconductor manufacturer on the planet. Was basically they're trending towards, what is it, 35 billion. He said they could be 10. They're nearing 10 billion a quarter on the QCT side. Now, just as a little bit of a reference, I believe NVIDIA is guiding towards about 25 billion. In revenue this year. So NVIDIA, which trades at well over 40 times forward earnings right now, even after it's been after a significant pullback, Qualcomm on the day of its earnings was around 17. So if you look at the way the market treats Qualcomm, I think what was being sort of insinuated through that conversation is, hey, we're fast growth, we're mid double digits, in some case high double digits, we're diversified, you know, which was something that Qualcomm was often accused of not being. Yeah. Because it was basically handsets. And I did a little bit of assessment of this, Pat, when I did a write-up on MarketWatch about this. And I just looked over the past couple of years. You know, in fiscal 1 of 20, for the first time they broke out those business units, it was a $3.6 billion total. So across those business units. At this point now, you know, you've seen handsets have doubled since they first reported. So that was 5 quarters. The handset has more than doubled. The IoT business has more than doubled. The IoT business now is a $1.5 billion a quarter business for the company. We've seen the RFFE grow about 22% from that time 5 quarters ago, but it actually, the full year 5 quarters ago, but that actually has grown much faster if you look at individual quarters before that. It was about 5 quarters ago that started that big ramp where they had their near first $1 billion quarter. And then automotive has also grown about 27%, but you can't forget that's a $13 billion pipeline that is now with their acquisition of Veoneer, or the Veoneer, the skateboard, the digital chassis acquisition. I want to say, sorry about that, I just totally slipped on it, but it was the ADAS part of the Veoneer business that they acquired. And then on top of that, you know, you add on all these subsets and you've got a business it's impressive, and about a third to 40% of it on a quarter by quarter basis of QCT is not handset. And I think that's a really important thing. And then behind all this, Pat, is you have a extraordinarily robust licensing business, which, you know, doesn't get talked about as much as it needs to be, but is one, extremely high margin, and two, it basically gives Qualcomm a piece of every dollar that comes in the 5G, basically for every 5G thing that sells on the planet. And the one last thing, Pat, I think worth mentioning here is, you said this really well, and it goes back a ways, but the sub it's the sub 5% expectation. Sorry if I doubled up on a couple of things you said, buddy. The sub 5% expectation for Apple over the next couple of years, I think has really put the market at ease. So you got this kind of opposing forces. You got fast growth, but the company's appreciation in terms of its PE has still been pretty slow. But at the same time, you've got a lot of the things falling into the right place. And lastly, the antitrust space seems to have sort of shifted away from Qualcomm, at least at the moment. And by the way, now that I say that, we'll probably see something get filed today. But in this particular moment in time, it seems that the Alphabets, Amazons, Facebook Metas seem to be much more in the crosshairs, at least at the moment. So
yeah, if I can I do a boomerang on this one?
And by the way, you said a lot. So if I did repeat any data points, it was only because I felt everybody out there needed to hear it twice.
I got you. No, I appreciate that. I just thought because you weren't listening to what I was saying.
Maybe.
No, it's funny. I want to put an asterisk. You had brought it up, kind of the Android growth versus Apple. I wrote a piece in Forbes that essentially said that Qualcomm in 2025 will be Apple proof. And essentially what that means is based on growth in all their other businesses and the growth in Android, Qualcomm is no longer going to be reliant as the biggest driver of their stock. In fact, Cristiano Amon and Akash said they essentially zeroed out Apple at I believe 2025 was the year. Correct me if I'm off on the year, but what I really liked is that they did 60% of their year-on-year growth in revenues was from Snapdragon, and essentially, it essentially means they're gaining market share in Android. And I think this is part of the becoming Apple proof. Anyways, I thought that was interesting. I think Cristiano maybe 2 quarters ago laid it to rest, but I think repetition is important. That for everybody to know that Qualcomm is essentially becoming Apple proof.
Yeah, it's a big one, and it's a river, by the way, that I was choking on. I could not. The Veoneer, the part of Veoneer that did not spin off was a river. Sometimes I think, Pat, weeks like this, when you're just digesting so much, that perfect factoid brain that I try to keep goes imperfect on me. So let's keep rocking and rolling, Pat, because there was a company, by the way, I think you and I both kind of put a tweet out. I stole your sort of Google tweet style look where I showed T-Mobile. They had a fairly big beat, if I'm not mistaken, and the line was something vertical. And so it was basically, this is a company that, had strong revenues exceeding expectations, not by a ton, but had a really big beat on its earnings. And then on top of that, the company had really great net adds in its 5G business, which is something that I think that, over the past few years, we had the John Legere era of T-Mobile where it was kind of the cool, everybody switch, pink, attention driving. But you said something to me in the green room, and I'm going to steal a little bit of your thunder because, I think it was really worth pointing out, Pat. And that's that for the last few years, 5G, as it's been coming into market, there's been a bunch of companies that have been playing in this space, AT&T, Verizon, and here in the US, and T-Mobile, I'd say, are the 3 biggest. T-Mobile, of course, did the deal with Sprint, but for the beginning period of time, we heard mostly about Verizon and AT&T. But over the last couple of years, while Verizon and AT&T have seemingly been focused on content and other diversification strategies, it appears that T-Mobile has been locked and loaded on 5G. They had a huge net add number this quarter, and I believe they've now reached 210 million customers on their nationwide 5G network. Now, think about that math in your brain a little bit. There's about 347 million people in the US total. I don't know if that number's changed much. That's a number I'm pulling from the back of my mind, but I think there's about 350 million citizens in the US, and they have 210 million customers by the end of the 4th quarter on its nationwide 5G network. So on top of that, though, what I thought really drove T-Mobile's numbers here, Pat, was guidance. And maybe it's worth reiterating that I've said this over the last few weeks. I've said this here. I've said this on other channels. I don't think people were necessarily expecting this quarter not to have good tech earnings. And despite all the headwinds about tech, I think most people said, well, this was really the October to December timeline. And remember, mid-November, the NASDAQ was at all-time highs. Tech was booming. The economy was looking very good. This was actually in November, October. This was before Omicron. So it almost was starting to look like we were on the backside of COVID before the next wave. And now what's coming, Pi or new or I don't know. But anyways, now that so we had about a month where it was in that period of time, 2 months where it wasn't, but very little that was going to impact earnings on these giant tech companies who had all these deals already in funnel, Pat. So what I did say was going to happen, though, was the market was going to be overtly paying attention, or sorry, acutely would be the right word here, paying attention to what do guidance numbers look like. If you look at like Facebook and Meta's numbers, they got destroyed because their guidance was bad, their CapEx was high, and their forward earnings started to look at risk. T-Mobile was the opposite. T-Mobile has extremely bullish net add numbers. They're looking at 2022, 5 to 5.5 million is what they're talking about. They're predicting strong earnings for the year, strong revenues, and strong growth. And they're focused on 5G. They weren't part of this FAA 5G C-band issue because they're operating in a different spectrum. Overall, I'll just leave it here. Great numbers, good growth, huge network. Customers are are using it, by the way. Disclosure, I'm a user of T-Mobile. And if you're an international traveler, by the way, I always loved it for that because of the relationship with Deutsche and T-Systems, especially when you go over to Europe. I never have issues. So over the last few years, improvements. One last ask, Pat, better T-Mobile service downtown Austin.
Yeah, that would be great. AT&T has it kind of locked downtown Austin here, but no, you brought up some great stuff, and if I could find the right tab here, I wanted to just show some of the amazing. I mean these net adds are off the chart, but let me strategically just talk about what T-Mobile has done. As AT&T was off spending $80 billion on Time Warner, $80 billion. And oh, by the way, they're going to spin it off and merge it with Discovery for 40. So that's like a $40 billion loss. And Verizon buying companies like AOL and Yahoo and trying to become a content play. Little old Sprint and T-Mobile really stuck to their knitting and stuck to the core of what they do. And that's providing great cellular service with expansion into business communications services. And that's exactly what we're seeing here. T-Mobile got mid-band by buying Sprint, and yeah, I get they're doing some spectrum acquisitions too. But net the company was there first, and quite frankly, if you look at what they paid for Sprint versus what T-Mobile and Verizon paid for C-band, it was an absolute steal. And now you see T-Mobile stealing all of these consumer customers away from AT&T and Verizon. So, listen, I understand the desire to not be a purveyor of quote unquote dumb pipes, but I don't think T-Mobile is that. But if I look at AT&T's disastrous acquisition of Time Warner, which includes the much often talked about this week's CNN. And then if you look at Verizon buying AOL and Yahoo, I'm expecting them to buy Napster next. Did I just say that, or what was I thinking that? No, I'm just kidding. No, I think this is just an exclamation point in sticking to the core, knowing what you're good at, and sticking to that. And this is part of the problem with being a public company: is you do stupid stuff in the name of growth. And I think what we saw at AT&T is senior management got run out, and there's a new crew in there right now, and their stock has done horribly. Anyways, having a good Friday.
Yeah, it feels like there's an analogy or a parallel to Succession here, although it's not actually, because obviously Succession was about more leaned to more what was going on with Fox. But if you think about it, I just think about that show. And if you haven't watched it, by the way, highly recommended. But I'm thinking about the beginning when they acquired that first sort of forward-thinking media company that they later decided to just dissolve because it was all a big sham. It sounds to me like some of the buying decisions of some of the other media slash mobile companies and their decisions looked somewhat similar to that. Again, there's kind of always those two opposing forces, Pat. It's growth at all costs and stay in your lane. And so sometimes staying in your lane is what you got to do to be successful. And at least at this particular point, T-Mobile has done that, and they've done it at the expense of the other giant carriers here in the U.S. And you got to give them credit where credit's due. So good job, T-Mobile. So Pat, we're going to hit the hyperscalers here at the end because they both reported. We're not going to dig in too much to the overall businesses. I might tap onto a few things with Alphabet, but let's talk about Google Cloud and let's talk about AWS Cloud. Let's start with Google. Yeah,
so let me flash this screen up here.
By the way, you're so good at this production stuff, man.
Listen, if this analyst thing, if I crash and burn on that, maybe I can do, be a producer
for me.
Exactly. Yeah, I'd love to be your handmaiden. Let's dive into this, and this is going to be really quick for me because, quite frankly, Google doesn't give a lot up about Google Cloud, and Google Cloud comprises IaaS, PaaS, and SaaS services. SaaS services like Google Workspace, and IaaS services like IaaS services, and everything in between. And they have they're very strong in IaaS and PaaS in machine learning and analytics, and they typically use it as a land and expand strategy to go in and get more. But net, Google Cloud had 45% growth all the way to $5.4 billion. You can do the math, gets them to a $22 billion run rate business that, quite frankly, is incredible. And the team there and the leadership team deserves a lot of credit. They are still losing a lot of money. They lost $890 million in the recent quarter, but that loss narrowed. It narrowed 39% year on year, and it narrowed $353 million. And that's it. I'm sticking to my guns, baby.
Yeah, I think we can keep this one fairly short, Pat. I had the chance to talk to Emily Chang about this. I'm doing my victory lap. You taught me how to do this. I'm so good at it now. But I enjoyed the opportunity to do this with Talking Alphabet. And this was the part that's most interesting to me. Look, the company's financials are incredible. The amount of revenue and earnings they create, but that's all the advertising business. The one thing I think everybody can pretty much shake off at this point is that the IDFA Apple stuff is going to hurt Google. It might, but not in a way that's anywhere nearly as adverse as what it's done to Meta. And I guess that's the difference of having people that use your platform because they want to, and people who are being advertised to because they want to talk to their friends. It's a totally different, experience, and people continue to go to Google, use Google. And by the way, we'll circle back because I would say Amazon's had a surprisingly big advertising business too. But the cloud business, Pat, there's a really simple conversation that's going to continue every quarter until it's not. And that's, do they become profitable? And by the way, do they need to be profitable? And that's probably, arguably, maybe the bigger question is, Google doesn't want to be number 3 or 4. And then depending on how they're being ranked, in some cases, they're sitting behind Oracle too.
That's right.
Google wants to be number 1. Google doesn't do things to be number 3 or 4. And so growing organically or racing for profits when you're creating huge earnings per share through other parts of your business, do you get the leeway from the markets to invest, grow, and not make money? And by the way, be pretty transparent about it, because a lot of companies could just hide that in that overall number and just say, hey, cloud's now X billions of dollars. We're not.
Well, and they did do that for a while. But they had to break out the revenue. But I'm saying they could be spouting off the revenue, Pat, and not sharing the loss. They could just say, hey, this is how much revenue we're doing, and just bury the actual loss into the bigger number. They're being transparent. So I give them credit for that particular action. They're going to try to grow. You see, we'll get to AWS soon, but over almost 18 billion a quarter. That's the number that's in the mind of Google. That's the number they're chasing. And all I'm saying is they're going to spend and they're going to spend. And don't even be surprised, in my opinion, if you see the losses stop narrowing.
you may see bigger losses, because if they're going to want to grow, they're going to need to make acquisitions. They're going to need to add services. They're going to need to build more data centers. They're going to need to buy more compute power. They're going to need to hire more salespeople. And I think they'll do it. And by the way, I don't know that that's wrong, because when you have the, when you have the business they have, the leading side of their company, I think they're allowed to do that. So I'm not saying it's right or wrong. That's a decision they'll have to make. But if their shareholders, and following their 20-to-1 split now, don't feel confident and don't get excited, and they're worried about Google Cloud and they sell for that reason, I'd be surprised, because it's growing at a good pace, not quite as fast as Azure, but it's growing at a good pace. They're narrowing losses for now. They're gaining customers every quarter. I think Google Cloud has a bright future.
Hey, and check this out. I had to share this with you, with the audience. So Corey Quinn, we kind of go back and forth with him on Twitter. He had a really interesting, by the way, he's an economist for his company, and he essentially helps AWS clients. And he had a really nice thing to say, and you can read it here, about Google Cloud. He said, essentially, if you were starting from scratch, he would pick Google Cloud. And I know people were talking about that. We were going back and forth about it, but that, if nothing else, is some pretty strong affirmation for Google Cloud.
Yeah, Pat, it's hard to not feel like they're going the right way. The knock is going to be profit. But I don't know if that's a knock when you got a business that's creating the type of income they have. Don't they get to make bets? Don't they get to invest in growth? Every company does that. The market can be disproportionately critical of things at times, but I would be betting more on Google's investment than Meta's silly $10 billion a year investment in VR headsets. So call me wrong when I'm wrong, but I'm not buying that $800,000 plot of land next to Snoop Dogg's metaverse house. Just not yet. Not yet. Not saying metaverse isn't real. Just hasn't. I don't think that's as smart of an investment as what Alphabet's doing. So hey, let's. We got one topic left to go, and let's stay on the hyperscalers, Pat.
Let's do this.
Let's stay tight. Let's stay narrow, and let's talk about the cloud business, because the huge one-time profit jaunt from Rivian, which was super cool and everything, that they were able to surprise by like $24 a share, that was a bit of a windfall. So that wasn't necessarily, didn't necessarily make entire sense. But what I will say, Pat, is that broader result did kind of save the market yesterday, because the market was in a tailspin. So I think after Meta's result, people were really thinking it might be doomy for Amazon. E-commerce was going to get crushed, but it was only up 1%, the actual traditional e-commerce business. But AWS, I'm telling you, I don't know how they do it. I'm being totally sincere. Like, you and I have talked about this quarter after quarter after quarter. Law of large numbers. The average growth is going to get harder. It's going to get harder because now they're a $10 billion company. Remember, now it's a $12 billion company, and now a quarter, $12 billion a quarter. Now it's $14 billion. How are they going? Pat, I think we did the metrics. Am I right or wrong that AWS now in total revenue, I think it surpassed IBM, just AWS? Yeah,
they just if you annualize their quarterly revenue, they just nipped IBM in the bud. And if you compare quarter on quarter, they did. Yeah. So that's not a knock. That's just to give perspective to the magnitude of AWS within the overall Amazon. So you got a business that's still growing 40%. Like I said, they started, remember, Pat, for a while, they fell into the high 20s and low 30s, and we're going, okay, we're going to start to see this pull back. We're going to see it in the mid 20s. It's going to slip into the 20s. And I would say that, the forces that are here for AWS is the diversification of their product portfolio. It started with storage networking, compute, all the core infrastructure, but they've gone up and down the stack from services to PaaS. They haven't overly tapped into software yet, which is still pretty nascent and a huge opportunity for the company if they decide to go down that route. But, hybrid cloud with Outposts, a very diverse set of services for AI and ML, Bracket for quantum, which I'm guessing isn't a huge revenue source yet, but it's going to be down the line. They're playing in that space right now. Edge and IoT, Snowball and everything that's going on there as a big business. So from edge to cloud, from public to hybrid,
AWS has a very comprehensive service. And of course, they never will say, hey, we're into multi-cloud, but they have, with ECS and EKS, built solutions for people that want to be able to do that with their own open source and development capabilities, using AWS to do that as well. And then finally, Pat, they've built a pretty healthy, profitable business on homegrown chips. They've got some really compelling, including all the stuff they're doing with Graviton. They launched the Graviton Challenge at our 6.5 event, which, I'd like to throw that out there every once in a while. And who knows, maybe they'll launch another Graviton Challenge at the 6.5 Summit in June. Throwing that out there, if anyone at AWS is listening. All right, but, Pat, I'll leave it there and leave a little bit for you. But it's a diverse company playing up and down the stack. Its growth continues to impress. And by the way, kind of the opposite of the Alphabet thing. It is the profit giant for Amazon. And while Amazon's core e-commerce and other businesses actually don't create a whole lot of op inc, AWS is an absolute margin monster.
Yeah, I mean, I'll just flash this up there, and hopefully you can see that AWS generated 152% of Amazon's operating income. And you might ask, well, gosh, how could that possibly happen? Well, it's because international operations lost 1.6 billion and North America lost 206 million. That's exactly how that happens. It's an absolute, cash machine. And the cool part is, they increased revenue 40%, but the increased op inc 48%. That must mean there are some fixed expenses that don't increase with the amount of business they do, like people, which is an incredible thing. The diversity of what you can get from Amazon is incredible. And it's truly ironic that their value proposition when they first started was simplicity, right? If you wanted a virtualized workload, you could get one, okay? One size of a virtual machine. And then IT was like, I need, multitudes of it, but they did it for scale. And then once they got to a point of scale, they then offered every flavor of compute, storage, and networking that any human, I think, would need. And then they kept adding more, right? And I like to consider what AWS does on EC2 compute as decommoditizing compute. There was this notion amongst other hyperscalers that compute was commoditized. And I'm a big believer. I spent 20 years in product marketing and product management, that you don't become commoditized. You allow yourself to be commoditized. And what AWS did is they, Daniel, as you said, started creating their own silicon on the compute side. And then, well, first actually on their networking offload. They did that for 8 years before they built their own compute engine. They have an inference chip, and they have a training chip that's in customer test right now. So I think they keep moving that forward. In quantum computing, right? They have one flavor of every type of technology: trapped ion, neutral atom, and superconductor. Right? Again, hedging their bets on this thing. And I wouldn't be surprised if they bring in even more partners into the fold. But quite a machine, Daniel. And yeah, it'd be cool to have AWS on again to chat about some type of challenge or maybe announce another program at the 6.5 Summit 2022, which is June 7th to June 9th. Hold your calendars.
I love that you put that out there. And by the way, Pat and I will also be bringing you some stuff live from Barcelona at the end of the month and early next month from MWC. Are we back? So far, so good. No cancellation yet. I'm thinking this is going to happen.
Yeah, if anybody needs some cool videos, wants to have some conversation with Daniel and I, we are there. We're going to have 6.5 in the booth. 10 minutes long. It's chill. We come into the booth, see some cool products. Heck, we don't even have to interview you. We'll just riff inside of your booth. Hey, you want more of a news desk? Kind of sit down on the couch like we did at CES. We have 6.5 on the couch. Oh, no, actually, it's called 6.5 on the road. But anyways.
Road, in the booth, at the news desk. We've got, actually, let's not do that because we've worked really hard to try to get these together. But listen, what a show, what a day, what fun we had. 6 topics. We covered them all: AMD, Honeywell, Qualcomm, T-Mobile, Google Cloud, AWS, and I even dropped the meta bomb a few times because how can you get through this week when a company like that loses like a third of its value in a day and not talk about it? But we appreciate everybody out there. I want to thank you all for tuning in. Hit that subscribe button. Good news to Pat, I mean to me. Bad news to Pat, I mean to me. Whatever works out. Keep in touch with us in the socials. We like to hear from you in our community. So for this week, for this episode, though, it's time to say goodbye. I promise we'll be back next week with more, better, thoughtful analysis on tech. See you later.
Bye, everybody.